Welcome to the Deep Dive. We take complex info, slice through it, and hopefully bring you some real clarity.
Yeah, makes sense of the noise.
Exactly.
Sure.
Today, we're diving into Marvell Technology, big semiconductor player. We've waded through their latest earnings calls, their financial filings.
All the good stuff.
Right, pulling out what matter. Their Q2 results, which were, well, pretty eye-catching. Their big pivot to AI, which everyone's talking about.
And even, a peek behind the curtain at their executive plans, which tells you a lot, too.
Yeah. So our mission today, for you, is to really unpack Marvell's fiscal Q2 26. Why the record growth, especially in data centers?
And how are they setting themselves up for what's next? What are the trends they're trying to catch?
We'll hit those less discussed bits, too, like the exec programs, trying to give you that full 360 view.
Definitely.
Think of it as your shortcut. Not just what Marvell's doing, but, why it actually matters for tech, for the whole semiconductor space.
Let's get into it.
Okay, so kicking off with the big picture, Marvell's Q2 fiscal year 2026. The numbers. They definitely tell a story, don't they?
Oh, absolutely. I mean, record revenue right off the bat, $2.006 billion.
Wow.
Which is a huge 58% jump year over year, and even 6% up from the previous quarter.
Okay, 58% year over year is massive.
It is. And that drove their record non-GAAP earnings per share to $0.67. That's up 123% from last year.
123%.
Yeah, it's impressive. And what's also really interesting, their non-GAAP operating margin expanded a lot, up 870 basis points year over year.
So 8.7 percentage points.
Exactly. Now sitting at 34.8%. That shows really, really good operating leverage. They're making more profit from their sales.
That's solid growth, solid efficiency. So where's the surge coming from? What's the main engine here?
Well, it's the data center. No
Right.
question. It's the star. Grew 69% year over year.
69%.
And get this, it accounts for 74% of their total revenue this quarter. 74%.
Okay, that's a huge concentration.
Yeah, it is. And within that, over 90% is directly driven by AI and cloud demand. But, it wasn't only data centers.
Right.
They did see a pretty strong recovery in enterprise networking and carrier infrastructure, too. Those together grew 43% year over year.
Okay, let's pause on that data center number. 74%, mostly AI-driven. That feels like, well, a massive opportunity, obviously, but also a big strategic bet,
But
right?
only a bet.
I mean, how do they talk about managing the risk? Putting so many eggs in that AI basket. What if the boom slows or competition heats up faster than they think?
That's the billion-dollar question, isn't it, for everyone in this space? Marvell often points to the deep relationships they have, these long-term deals, especially on the custom silicon side.
Creates stickiness.
Right, exactly, stickiness. But you can also read between the lines in their filings. There's this constant pressure to innovate within the data center space.
Right, not just one product.
Yeah. Diversify the wins, avoid getting too dependent on one customer's ups and downs. It's definitely a calculated risk, but, they clearly feel it's where the major growth is. You kind of have to be there.
Okay, so that leads us right into their strategic moves. This pivot. We heard about them selling off their automotive Ethernet business.
Yeah, that was interesting.
Why sell something they called great? What's the thinking?
Well, it's that classic strategic dilemma, isn't it? Sometimes even a good business isn't the best use of resources. Their CEO, Matt Murphy, basically said, look, automotive was strong, we built it up.
From scratch. Yeah.
But it was still a pretty small slice of the overall revenue pie. And then AI just exploded, making it look even smaller, relatively speaking.
So focus.
Exactly. Sharpen the focus on what they called the massive AI opportunity. Redirect those R&D dollars, that management attention, squarely onto the data center. It's the main engine now.
Makes sense. Like shedding weight to run faster, as you said.
Pretty much. And the cash from the sale gives them flexibility, too, for stock buybacks, strengthening their tech platform.
So pure focus and resource allocation. And they're changing how they report other stuff, too. Consolidating everything that isn't data center.
Correct. Starting Q3, everything else, enterprise, carrier, et cetera, gets lumped into one segment called communications and other.
Does that mean they care less about those areas now? Or is it just tidying up the books?
I think it's mostly reflecting reality. The data center is just so dominant in their revenue mix right now.
Yeah, 74%.
Exactly. It simplifies the story for investors. Doesn't necessarily mean those other areas are neglected. They still need to manage them. But the main growth story, the main focus, is clearly data center.
Okay, now this gets really interesting for me. They had that investor event focusing on custom silicon.
Ah, yes, that was key.
They boosted their TAM forecast for data centers
Uh,
and talked about XPU attach. What was the biggest news out of that event, you think?
I think the biggest thing was just the sheer scale of their ambition in custom silicon and the fact they have early wins to back it up. They bumped up their data center TAM estimate to $94 billion by calendar 2028.
94 billion. Wow, that's a big jump.
Yeah, up 26% from what they thought before. And they introduced this new category, XPU attach. Now, for listeners, an XPU is just shorthand for basically any specialized processor, right?
Like a GPU, AI chip, DPU.
Exactly. Chips built for specific heavy-duty tasks. Marvell says they've already won 18 deals for multi-generational XPU and XPU attached sockets.
Okay.
And the pipeline. Over 50 new opportunities they're chasing. They estimate that pipeline alone represents a potential $75 billion in lifetime revenue.
$75 billion. Potential lifetime revenue.
God, that's just a staggering number. Is that realistic? What makes them so confident?
Well, it's definitely ambitious. Their goal is to go from having about 13% market share of today's $33 billion TAM in 2024 to capturing 20% of that much bigger $94 billion TAM in 2028. So bigger share of a much bigger pie.
Their confidence seems rooted in, well, two things. One, their early custom programs are working, they're delivering. Two, the whole industry is moving towards custom silicon.
Because the chips are getting so complex.
Precisely. As these next-gen XPUs get more specialized, companies want tailor-made solutions for the best performance and efficiency. And that plays right into Marvell's custom capabilities. They're seeing the demand directly from customers.
Okay, makes sense. And inside these data centers, what about the plumbing, the interconnects, holding it all together? Sounds like Marvell's big there too.
Oh, hugely important. You can have the fastest processors, but if they can't talk to each other quickly,
Bottleneck.
big-time bottleneck. So yeah, Marvell's heavily involved in what they call scale-up networks. These are needed to link thousands of XPUs together tightly for AI training and inference. Needs crazy low latency, massive bandwidth.
And their custom work helps here.
It gives them a unique advantage, yeah. Because they're designing custom silicon with these big players, they get early visibility into the next XPU architectures.
Ah, so they can design the switches and interconnects to match.
Exactly. They can design switches that support standard Ethernet and the proprietary links some customers use. They're also leading in the electro-optics piece.
Right. You mentioned PAM, DSPs, and NPO, CPO. Can you quickly break those down?
Sure. So PAM VSPs, those are sophisticated digital signal processors. They basically let you cram way more data down fiber optic cables, essential for the speeds AI needs.
Like 800 gig, 1.6 terabit.
Right. They're shipping 800 gig now, seeing strong demand, and the next-gen 1.6T versions are starting to ship. And then NPO and CPO near and co-packaged optics.
Okay.
That's all about putting the optics, the light stuff, super close to or even right on the main silicon chips.
Why do that?
Cuts down power draw, boosts data speeds massively. It's about breaking down old barriers between the electrical and optical worlds, future-proofing, really. They even showed off 6.4 terabit silicon photonics light engines.
6.4T.
Yeah, which they see as key for making NPO and CPO practical down the road.
Okay, so data center is clearly the juggernaut. But it's good other parts are recovering too, right? Enterprise networking, carrier infrastructure.
Yeah.
How big a deal is that turnaround?
It's pretty significant, actually. Good for the overall health. Shows they're not just a one-trick pony, even if that trick is, massive.
Right.
These other businesses, they'd really hit a low point, down around a $900 million annual run rate during that whole inventory correction phase everyone went through.
Yeah, that was tough.
But their forecast for Q3 implies a rebound back up closer to a $1.7 billion annual run rate for those segments combined.
Wow, almost double the low point. What's driving that?
Two things, mostly. One, customer inventories are finally getting back to normal levels after all that over-ordering. Two, Marvell's refreshed their product lines in those areas, moving them to newer manufacturing processes, which helps performance and longevity. So it's a healthy rebalancing act.
That's a big swing back. And financially, beyond just the revenue, how are they juggling all this growth and the pivot?
Yeah.
Are they managing the finances well?
Seems like it, yeah. Financial management looks strong. Cash flow from operations in Q2 was about $462 million.
Solid.
Yeah, up $129 million from Q1. They also managed to bring inventory down by $20 million, which is usually a good sign of efficiency.
Right, not holding too much stock.
Exactly. And on the debt side, they paid off the rest of their 2026 term loan in Q2, about $558 million. So, cleaning up the balance sheet.
Good move.
And they're still returning cash to shareholders, $52 million in dividends in Q2. Plus, they still have $2 billion authorized for stock buybacks. So, yeah, seems quite deliberate.
And what about those government incentives I saw mentioned? What's the play there beyond just getting some extra cash?
Right, that was interesting. On May 1st, 2025, they got approval for incentives from some unnamed foreign government.
Huh?
These run until 2030, and they can work in a few ways. Reduce cost of sales, cut operating expenses, offset income taxes, or even just be refunded as cash. Very. Strategically, yeah, it lowers their costs, makes them more competitive, but it can also be about signaling commitment to investing in that region, strengthening supply chain options, potentially.
Smart diversification, maybe?
Could be part of it. Of course, it depends on them hitting certain investment targets and government reviews, but it's a savvy move to optimize globally.
Okay, so we've hit the AI focus, the financials,
Yeah.
but leadership drives everything, right? What do these new executive plans, the severance and retirement programs, tell us about how Marvell manages its top team?
Yeah, this stuff is fascinating. It gives you real insight into how they plan for stability, potential M&A, leadership changes, all crucial when you're executing a big strategy.
Right.
Take the Change and Control Severance Plan. They updated it in June 2025. It lays out what happens if an exec is let go involuntarily or if they resign for good reason after the company changes control, like in a merger.
So it provides security during uncertain times.
Exactly, but it also signals to the market, hey, we value our leadership, we plan for continuity. That's important when you're making these huge bets on AI. It helps de-risk the people part of the equation.
Okay, so what counts as good reason for an exec to leave and still get benefits under that plan? Why are those specifics important?
Good reason covers quite a bit. It's designed so execs don't get penalized if their job fundamentally changes negatively. Things like a major cut in their duties or responsibilities.
Demotion, basically.
Yeah, or a significant pay cut like 10% or more off base salary or target bonus. Even being forced to relocate more than 30 miles if it really messes up their commute.
Practical stuff.
Right. And the benefits are tiered based on seniority. Could be 6 months salary, could be 24 months, plus a percentage of their target bonus, full acceleration of their stock awards, and continued medical benefits.
Robust package.
It is. The specifics matter because they give executives confidence. They can focus on the long-term strategy without worrying quite so much about their own situation if things suddenly shift.
Makes sense. And the other one, the Senior Executive Retirement Program. Effective May 30th, 2025. What's the goal there?
This one's more about planning for expected departures. It gives consistent benefits to execs who choose to retire, provided they meet certain criteria. The main one is the Rule of 65.
Rule of 65.
Well, you have to be at least 55 years old, have at least 5 years of service with Marvell, and your age plus years of service has to add up to 65 or more.
Yep.
The CEO has another option too, like staying on as an executive chair or advisor. The benefits include getting a prorated bonus for their final year. Their stock awards continue to vest.
Even after they retire.
Yeah, generally vesting continues, with performance goals usually met at target or based on actual results achieved. Plus, they keep medical benefits until they hit 65.
So it's about smooth, planned transitions for senior folks.
Exactly. Recognizing their contribution, avoiding sudden gaps, ensuring knowledge transfer, it helps structure those exits gracefully.
So, okay, these plans aim for stability, rewarding loyalty, smooth transitions. But no company, especially one betting big like Marvell, is risk-free. What risks are they highlighting that could potentially derail this AI strategy?
Right, connecting it back to the big picture, they're pretty upfront about several key risks in their filings. Customer concentration is a big one.
The 74% data center concentration.
Well, even broader than that, their top 10 customers overall accounted for 81% of total revenue last fiscal year.
81%, that's high.
Very. So if any of those big relationships change, it hurts. They also flag macroeconomic risks, inflation, interest rates, recession fears, things that could dampen customer spending.
Standard stuff, but important.
Definitely. Then there's cybersecurity, managing their debt load, and crucially, their reliance on third-party chip foundries.
like TSMC.
Primarily, yes, especially those located in Taiwan where a lot of their manufacturing happens. That brings in geopolitical risk.
Yeah, that seems particularly relevant right now. How exposed are they there, and what do they say about managing it?
It's highly relevant. They explicitly mention risks from tariffs, trade restrictions, especially involving China, that can limit sales or mess with supply chains.
The U.S.-China tech tensions.
Exactly. And the political situation between China and Taiwan, where their foundries are, that's called out specifically as a potential major disruption.
Do they say how they mitigate that?
Not in detail, beyond general talk of supply chain diversification efforts, but the fact they highlight it so clearly shows they know it's a major vulnerability. They also mention keeping a close eye on AI regulations.
Ah, new rules coming.
Potentially. New frameworks could mean higher costs, more compliance hurdles, another layer of complexity for their big AI push. So, tying it all together for you, Marvell is making really bold, focused moves, betting hard on AI and data centers, shedding other assets, going deep into custom silicon.
Calculated moves.
Calculated, exactly.
Yeah.
And the financials so far reflect that focus working, plus you see recovery in their other core areas. But
There's always a but.
always. They're juggling market risks, financial risks, and these significant geopolitical tensions. It demands constant attention, constant adaptation.
Yeah, what really stands out to me is that aggressive custom silicon play, that huge AI bet. It's backed by strong numbers right now, and they've clearly thought about locking in leadership.
It's a company actively reshaping itself. Huge potential payoff, but also, concentrated pressure points.
Definitely. So as you think about all this, maybe consider this. In today's tech world, is this kind of intense focus on one massive trend, like AI the smartest path to huge growth? Or does concentrating your bets like that just create new, perhaps even bigger risks that companies have to constantly find new ways to manage?
Something to chew on.